Welcome to the big show. This is Investing with Confidence. I am your host, Joshua David, and we are happy to have you with us today. As always, I do have my great friend, and he is a great pal. He is the one and the only Mr. Al Connickson. Al, how the heck you doing today?
Yeah, I'm doing really good. A lot of people say it's a good thing there's only one Al Connickson, but I'm happy to be him and happy to be here. How you doing, Josh?
I'm doing really good. It's a lot of fun talking about the financial markets with it. We talk about a lot of different things, and it's really fun helping our listeners become more financially literate.
Absolutely. That's our goal.
And that's one of the downfalls with, I guess, us here in America is most people don't really understand how the financial markets really work. What really drives the stock market? Well, how does it really function? And that's some of the stuff we're going to talk about here today on Investing with Confidence, sponsored by Online Trading Academy. So, Al, as we get into this first segment and then in the first topic, there's been some wild, crazy things going on in this market. You know, the big banks and the retail investor, what's going on. But there's also been some new terminology that a lot of people may have heard about, but just don't understand that. So I want to talk about that stuff, some of that stuff here today to help our listeners understand what's really going on with these crazy markets. Before we do that, what is happening? What are some of the catalysts that are driving these markets? We've seen some great volatility again, which was what we want as a trader and investor.
Yeah, there's no lack of volatility. That has certainly been there and will continue for some time. We've had all sorts of things happen, including a presidential election and another impeachment. But, the real basic, I think, thing that has caused this volatility is we got a lot of cheap money out there. Interest rates are basically zero. A lot of people are opening margin accounts, commission-free trading. You got the stay-at-home, kind of the quarantine society. A lot of people getting stimulus checks that are putting them into the market. So we're seeing a lot more retail involvement. But, you mentioned the craziness, and I think most people have at least heard something about, the GameStop and AMC and some of those stocks that were heavily shorted. And then, the increases in them, the percent increase, the dollar increases were unbelievable.
Yeah.
But you know what, Josh? It really gets down to what we talk about every day. Why was there such an increase in the value of those stocks? And why have they now come down in value?
Yeah, it's actually pretty simple.
It is buyers and sellers. The value of any one of those stocks would not have gone up if there weren't a lot of buyers there. And in this case, it probably was a lot of the retail traders that started that. But then you had a lot of the big players, the hedge funds that, and we don't want to get into too much detail on the the mechanics of what happened, but basically they were covering their short positions. They had to do that. It just caused a huge amount of buying, and then after the hedge funds had kind of finished their unwinding of their positions, then all of a sudden those stocks came crashing back down. And unfortunately, a lot of the people that got in late, it's sort of like a one of those pyramid things. It's the people that get in first that do well. The people that get in last get burned.
Well,
so
what's happened is it just created a lot of emotion. There was a lot of talk about it, but as you're saying, it doesn't really matter what drives it. As long as there's more buyers and sellers, price is going to go up.
Right.
More sellers than buyers, price is going to go down. That's really how the market really functions. It's supply and demand at its greatest.
Yeah, and we have kind of been taught that we need to look at the fundamentals. Really analyze something before you make a decision whether to buy or sell. Well, the fundamentals did not change numerous times over the last few weeks, and they didn't change that significantly. So, a lot of the people that are listening, Josh, we always talk about financial illiteracy, and the reason that there is so much of that in this country, in the world, really is because of a lack of education, and that's where we step in. But if you're listening because you're interested in taking control of your financial future, if that's the case, can you afford to do it without knowing how to increase the odds of being successful? Because that really is what we kind of key in on, is the probabilities. We're not in the prediction business. We're maybe more in the probability business. No one is ever going to be 100% successful, but your goal should be to have, the potential of being as close as possible. So how do you do that? Well, you start by saying that if you have to be able to, let me put it this way, you have to be able to identify with a high degree of conviction if something is going to go up if you buy it. And you have to also be able to say with a high degree of conviction that something is going to go down in price when you sell it. If you can't do that, with that high degree of conviction, then you're gambling. If you want to gamble, go to a casino and do that. Mm-hmm. Don't do it in the markets. And, speaking of casinos, why do the casinos always win? Why do the people walking in off the street, the real gamblers, why do they lose? It's because the odds are in the casino's favor. They're
Yeah.
setting the rules. They have the confidence in knowing that the rules they set will put the odds in their favor. And you can do the same thing as a trader or investor. You start with understanding how the markets function. You need to know that first. And we really have mentioned the key factor. It's that relationship between buyers and sellers. In other words, the relationship between supply and demand. And if once you understand that that's really what moves price, then what becomes important is how to use that in your favor. How do you use supply and demand, that relationship, to put the odds in your favor? And our students have a foundational strategy, a core foundational strategy that they use that helps them to identify an imbalance between the buyers and the sellers, which is like what happened here over the last few weeks. More buyers come in to any individual asset of the market, price will go up. More sellers come in, price is going to go down. How great would it be if you had a strategy that would help you identify where the buyers were going to enter, where the sellers were going to enter before they actually did, so you could be positioned?
Yeah, well, basically, it's a strategy that you're going to want that's designed to teach you to do that. And it's one of those things that we're seeing a lot of people want to learn about is how these, how the buyers really move price up, how the sellers really do it. But it's in big quantities because it takes big money to actually move price. And I'm glad you brought up a couple other terms like odds. You got to put the odds in your favor. It's just like the casino. They have the odds in their favor. It's designed that way. I believe it's 52% to 48. I think something like that. But that's an odd in the favor.
Yeah, absolutely.
But the key thing is they follow a plan. They follow the same strategy every single time, and that helps them get to where they're at. And in trading and investing, you want to have a plan, and you have to follow the rules within that plan to make better investing decisions. Take the emotions out of it.
Exactly.
So, Al, you talk a lot more about how to create financial plans, how to put odds in your favor. And Al, I mentioned trading any assets in any market. We're going to talk about the stock market a lot today. We're also going to talk about multiple asset classes. We're going to get into leverage and 24-hour markets. We'll be right back.